Hello, I've been looking forward to doing a commentary. We've been working on our technology for some time and want to be able to move more and more into video, and thought that what we would do is take a big step back and explain where we've been from an economic perspective, and then what we see going forward and how the works, and then how to invest in such an environment. And so what we plan on doing is a series of videos so that you can break this up into, bite-sized chunks and take your time with it, and maybe focus on the areas that are most interesting to you. I want to talk about the economy, where it's headed, how the big picture of the big cycle tends to work over time. Also, some of the challenges that we face, whether we're going into a recession or not, what that means, the implications of it, inflation, how that affects interest rates and markets, and how that's worked in the past, and then different ways that we can invest. And you're going to be familiar with a lot of this. I review it during meetings, but we're just trying to put it on one place and where you can take your time with it if you want, and focus on the areas that you find most interesting. So bear market versus bull market. This is really talking about secular bear markets, which means the long-term trend. And that trend is largely driven by inflation. And inflation is largely driven by debt, which we'll come back to. But a bull market is where you have high interest rates and high inflation, and those are coming down. And the reason that helps is when you have high interest coming down, it makes bonds more and more valuable. So you get a really great return on bonds. That process started in, well, big picture, about 1981, after the high inflation of the 70s. And interest rates came down. I mean, they went down and up, and on average, they came down and they hit bottom in 2020. 2021. And then we got a lot of inflation that was driven by the spending during COVID, in response to COVID. And the spending didn't cause inflation right away. You need a catalyst. And that catalyst was the reopening of the economy. So the government, and we'll get into this more later, but they spent a lot of money, did direct deposits, handed it out to people in both 2020 and 2021. And when the economy reopened in 2021, people went out and spent that money. And when you have too much money chasing too few goods, you get the cost of goods going up. And that causes interest rates to go up because you want to get what's called a real return, a return above inflation. And that causes stock prices to come down because you now have an alternative. You can either go into bonds or you can go into stocks, and bonds become more attractive. So stocks have to perform better than bonds going forward. To do that, their stock price has to come down in the short terms to get that go forward yield. So that's a bear market when you have what's happening, increasing inflation, increasing interest rates, decreasing price to earnings multiple. That's a bear market. A bull market, again, is decreasing interest rates, decreasing inflation, and increasing the price of stocks. And we'll get into that. So when you're investing, you just want to be cognizant. Big picture, are we in a bear market or are we in a bull market? If you're in a bear market, you just have to work harder, and you have to be more cognizant of risk and downside. You really want a risk management. You're not really trying to hit a home run in a bear market. You're really trying to protect yourself. Where in a bull market, you just index, take on a lot of risk, and you get better returns. In a bear market, you really want to mitigate risk, be much short-term oriented, rebalance more often. There's a lot of strategies that can work well in a bear market. I'd say most investors kind of do the same thing in a bear and a bull market.